Wednesday, May 13th, 2020, MONERO 64, home of alternative economics and contrarian views. The title of this video is Warning, UK Sovereign Debt Default Alert. It might sound clickbaity, but it isn't. This is what a leaked paper from the UK Treasury has warned that could happen if the UK economy doesn't recover well as a result of this crisis. I'm going to go through the story in the Mial Online. So before I get into it, I'll just read you the part where they warned about the UK debt default. And it's coming from the UK Treasury. It's not MONERO 64 warning you. So it says the Treasury document warned that if the economy does not recover soon, the country could be thrown into a 1976 style sovereign debt crisis that could require an international bailout. Yes, you heard it. This is the UK Treasury, not me, as I said. Before I go further, just have a sip of some of my water in my NDECB mug. Billy, by the way, we were talking this morning. We had a Cobra meeting, so to speak, and we were talking about the fact that they're saying they're going to increase the VAT maybe, which is the value-added tax, to try to cover the huge deficits. And Billy said to me, wow, we need to get some silver. And he's right. I know a lot of you do access silver without VAT, but many of you don't. So that could be something that people need to think about. Get their silver now before the VAT increases from 20 to 25 or 30%. They're going to have to pay for this. The only people who don't pay for things, of course, are the bankers most of the time. They get bailed out and then they actually get paid big bonuses, but not us, the plebs, or the deplorables, of course. So let's go through this story. I mean, everyone has access to Mial Online. Everyone that has access to the internet is a very popular paper, the Daily Mail. But you need to comb through the statements and interpret them in a way that, how can I say, gives you an edge, I would say, on what the general public is doing and what the mainstream economists are doing, what mainstream financial advisors are doing. The other day I was reading the Telegraph section, money section from Saturday, and there's no talk about trying to protect yourself with precious metals. It's always the same story. Oh, get an ISA, put it into this high interest account with national insurance, get a tax break. But there's no talk of trying to protect yourself through precious metals. So let's go through this article. And it's not just about the sovereign debt default. It's about the whole economic situation. So Britons face pay freezes and tax rises to cover £300 billion bill for the virus. Leaked Treasury plans reveal as it emerges that 1 in 3 firms may never reopen and employers could have to pay staff to do nothing under Rishi Sunak's furlough extension. Rishi Sunak is, of course, the Chancellor of the Exchequer, the equivalent of the Treasury Secretary in the US, or the equivalent of a Minister of Finance. So let's go through this. This is very important, and I'll tell you why I think it's very important after we've gone through this, especially as it pertains to the financial markets and interest rates. Leaked Treasury paper suggests a 300 billion body blow to UK PLC from the enforced lockdown. Document for the Chancellor sets out proposed wide-ranging tax increases and spending cuts. So just stop at this point here. We saw that Treasury's warning that if the economy doesn't improve, we could have sovereign debt default. What's the worst thing you can do for an economy that's in the doldrums? Well, it's to raise taxes. It's also to cut spending. That's the complete opposite of what you should do. And I'm not a Keynesian. I'm not suggesting government spending, but we do live in a Keynesian world, unfortunately, and that's what will happen. The economy won't improve if they followed these suggestions. So you can be almost assured, in my opinion, that there will be a sovereign debt default crisis in the UK. Official statistics this morning showed the UK economy contracted by 2% in the first quarter of 2020. GDP plunged 5.8% in March alone, the largest monthly fall since records began in 1997. Yeah, I think the focus today is on these GDP numbers. I'm not sure there will be anyone covering this sovereign debt danger like I'm doing, but let's keep going. Headache for Rishi Sunak, who has spent billions of pounds on shoring up businesses and workers' wages. Boris Johnson last week told MPs he had no intention of returning to the A word, austerity, in future. Would mean that much of attempts to recoup cash would have to come through tax increases. So you want to get the economy recovering, but you're increasing taxes, you cutting spending. How's that going to work? Unfortunately, I think what this crisis has shown is that the country, the UK, we've lived on the back of the state, welfare state, on the back of credit and debt and consumption for too long. And now we're going to have to pay the price for it. As my dad used to say, money doesn't grow on trees, and there's no such thing as a free lunch. And we're going to have to pay it one way or the other. And I think this is the moment where we start paying. And let's keep going. Britons face years of higher taxes and possible cuts to public spending as the nation attempts to overcome the economic shock of the virus. It was revealed today. Leaked documents suggest a 300 billion body blow to UK PLC from the enforced lockdown, with Chancellor Rishi Sunak making major changes to keep the country on an even keel. The other thing I would say before I go further is that usually forecasts by the IMF, World Bank, Bank of England, Fed, politicians, they're always too rosy. Keep that in mind. On the day Britons were officially allowed to return to work, official statistics this morning showed the UK economy contracted by 2% in the first quarter of 2020 and plunged 5.8% in March, the largest monthly fall on record. The first quarter fall was the worst since the end of 2008 at the height of the financial crisis, and came despite including just a week of lockdown, with April numbers expected to be far worse. The situation presents a headache for Mr. Sunak, who has spent hundreds of billions of pounds on shoring up businesses and workers' wages. Well, yeah, it's kept workers going, but the businesses are probably not going to exist anymore. It's going to be very hard to pay for all this deficit spending, of course. But But it is also a problem for Boris Johnson, who last week told MPs he had no intention of returning to the A word, austerity, to get the economy going again. Well, I think what we're going to get is a mixture, high taxes, spending cuts, some spending cuts, not too much. I think that's just for the markets. They're really going to pump up the printing presses. We're going to get inflation. That's probably the best way to write off debt, to pay things off with money that is worth less. And I'll come to the point that I want to make about interest rates and what you need to do to protect yourself, in my opinion. Keeping to this vow limits his options, and unless he performs a complete U-turn, it would suggest that massive tax increases will be the focus of the economic recovery plan. That statement doesn't make sense. Massive tax increases will be the focus of the economic recovery plan. How do you do that with massive tax increases? I don't get it. Put a link to this article below in the description. You can read it. Before I go further, just wanted to point out FT headline saying here, UK manufacturers push back against 14-day quarantine plan. Key sectors warn of disruption to production, supply shortages, and more job losses. So not great news. Let's keep going. The March fall is the worst since records began in 1997, while the first quarter drop is the biggest since the UK economy contracted by 2.1% between October and December 2008 in the recession that followed the financial crisis. It also compares with zero growth in the final 3 months of 2019. So, yeah, the economy wasn't doing well already. So this has just been a catalyst, and it probably would have happened even if we didn't have a crisis. And yeah, so let's keep going. But the ONS, which is the Office of National Statistics, a government bureaucracy, cautioned that there was more uncertainty than normal over its first GDP estimate, given the challenges of collecting economic data amid the lockdown. And there is far worse pain to come, with the Bank of England last week warning the virus could see the economy plunge by a further 25% in the second quarter and fall by 14% overall in 2020, the worst annual fall since records began. As I said, these people forecasts are always very conservative, so think a bit worse than that. Asked about the GDP figures today, Mr. Sunak told Sky, and I quote, "In some senses, they are not a surprise. In common with pretty much every other economy around the world, we are facing severe impact from the virus. You are seeing that in the numbers." And this is an interesting comment here. And that is why we have taken the unprecedented action that we have to support people's jobs, their incomes, and their livelihoods at this time, and support businesses so we can get through this period of severe disruption and emerge stronger on the other side. That doesn't make sense either. How can the economy emerge stronger on the other side if you're going to have to probably tax people, massively increase their taxes, inflate their currency, cut spending, millions of people are going to lose their jobs. It's not going to come out better on the other side. It doesn't make sense. This is for public consumption. A paper drawn up for Mr. Sunak and seen by the Daily Telegraph said austerity-style policies, including drastic cuts to public spending and welfare, may have to be announced within weeks to boost confidence in the economy. That again doesn't make sense. Boost confidence in the economy by doing this. What I think they mean is confidence in the financial markets, confidence in the British currency, in the pounds, and in government debt. If you remember a few weeks ago, well, over a month ago, when the stock markets were collapsing, the British pound was collapsing as well. I think we got down to 114, and then all of a sudden it just rebounded like 10 big figures over a couple of days. Well, that was the Federal Reserve bailing out the United Kingdom through their swap lines and through repos for central banks. If they hadn't done that, you could have seen a rush out of gilts by foreigners. That would have driven up interest rates. So let's keep going. It could lead to rises in income tax, VAT, and national insurance, as well as an end to the pension triple lock, guaranteeing the state pension rises each year by the highest of inflation, earnings growth, and 2.5%. You can bet inflation is going to go very high in this country, and the state pension might not be cut, but it's going to stay at the same level nominally, but in real terms, you're going to be losing out. New green taxes or levies targeted towards the NHS or social care are also being considered. Just what we need, right? Green taxes and levies. It's going to really help the economy. It said there was a base case scenario for a $337 billion budget deficit this year, compared with a forecast of $55 billion in March's budget. And when I talk about the UK fiscal situation, I always like to go back to Gideon Osborne, the former Chancellor of the Exchequer, or George Osborne, if you want to call him that, but his first name is Gideon. When he became Chancellor in 2010, he gave out his budget, and he said that the UK was going to pay down its deficit, annual deficit, and we're going to balance the budget by 2015. So here we are now in 2020, and even before the crisis, we had a $55 billion deficit. But now it's going to go up to almost $500 billion, which is quite amazing. Earlier it emerged businesses could have to stump up half of furloughed workers' pay, even if they remain closed, as Mr. Sunak revealed plans to extend the massive job retention scheme until October. Well, that's going to result into more and more unemployment. Don't think firms are going to keep paying their workers to do nothing. Would you, if you had a business? Now the leaked document, dated May 5th and marked official, market sensitive, says tax rises and spending cuts that would raise between £25 billion and £30 billion, equivalent to a 5p or 5% increase in the basic rate of income tax, would be needed to fund the increase that, well, yeah, the 5p means that, let's say the income tax is 20%, they raise it to 25. So this is where it starts getting interesting here. I know this is going on for a while, but I think this is very important, not just for the UK viewers, but viewers in most Western nations, I think, because they're in the same boat as we are. I think the UK is worse because we have a lot of external debt, though. That's a huge problem for the UK. In the worst case scenario, the deficit would increase to $516 billion this year, rising to $1.19 trillion over 5 years. This would need up to $90 billion in annual tax rises or spending cuts in the coming years. Even the best case scenario in which the economy recovers quickly, very unlikely, I would say, would lead to a $209 billion deficit. This is described as optimistic. The prediction suggests the UK economy could be in its worst state since 1945. And an independent survey of small firms has found that 1 in 3 may never reopen, adding to the government's woes. The survey of more than 5,000 British companies published by the Federation of Small Businesses also found that 7 in 10 of the respondents are using the job retention scheme. However, 1 in 3 employers are considering or have already made redundancies in their workforce, raising concerns over planned changes to the scheme in August. Mike Cherry, the Federation's chairman, said the government's support through the furlough scheme, as well as other grants and loans, would need to be carefully tapered away. The economy will not go from 0 to 100 overnight once we're into the recovery phase. The crucial support that's on offer needs to be kept under review as we chart a course back to economic recovery, he told the Times. The other thing I would say, I spoke about this in my earlier video today, Sam Zell, an American investor, who said that just because the economy reopens, restaurants reopen, people can travel again, they can go to hotels or shopping malls, it doesn't mean to say that people are going to go back to those places because they're going to be concerned for their health. So here we come to the warning of this video. The Treasury document warned that if the economy does not recover soon, the country could be thrown into a 1976-style sovereign debt crisis that could require an international bailout. I guess you can read IMF for that. I won't go further into the article. We'll stop here. What's certain, though, for me is that the economy will not recover very well, nor very soon. Things are going to be worse than expected. And why do I always keep saying that? Well, because politicians, governments, central bankers, they're always trying to sell a much rosier picture. But as you can see, this picture is not rosy at all. They're trying to look at the best of a really bad situation. But what happened in the 70s? Where were interest rates when the UK had to ask for a bailout from the IMF? I think it was 1978. They did say 1976 style, but I think it culminated in 1978. Well, I looked at an annual report from February 1976 from the Bank of England. I found the document online, PDF. And before I show you where interest rates were back in 1975, I just wanted to show you this here. The Court of Directors of the Bank of England in 1976. And we're told that the Bank of England was nationalized in 1946 after the war. But look at their list of directors. If you go down a few lines, Leopold David de Rothschild, Esquire. So much for the Bank of England being nationalized and being a public institution when you have bankers in the Court of Directors. Just wanted to put that out there. So let's go to the page where you can have an idea where interest rates were back in 1975. So there you go. Operations undertaken during the year included. So they've got issues for cash. I guess this is a Treasury and other institutions like Greater London Council, City of Liverpool, and so on. But if you look here, 3rd of July, Treasury loan due in 1995. So that was a 20-year gilt, 12.34% coupon. The price was at 88.50, so below par. So you can bet that rate was even higher than the coupon. it was probably 15, or I haven't done the calculation, but it's just to give you an idea where interest rates were. You look at 16th of October, 11.5% coupon Treasury stock, 1981. So 5-year gilt with a price of 96. So interest rates for 5-year, the Treasury had to pay over 12%. So you get the idea, double digit yields, which means that the government had to pay more than 10% to borrow from the markets. And when I saw that warning from the Treasury paper itself that we could have a sovereign debt crisis in the UK, that the UK might need a bailout if the economy doesn't improve, alarm bells rang in my head. Not for myself, because I don't own any gilts, and I don't plan to buy any. I think people who are buying these investments, lending the government money through gilts. Gilts, of course, are the UK equivalent of US Treasuries. I think they're not doing their due diligence if they're managing money and buying these things for the investors that they're supposed to provide a fiduciary duty to. I don't think they're doing that, because if you look here, this morning, for example, I did a screenshot of this. This was a little earlier. So if you go to the 50-year gilt yield, investors are willing to receive only 0.364%. So they're willing to lend money to the government and not get even 1% for 50 years. And you saw that in 1975, investors were asking for 12% to lend them for 5 years. I mean, look at 10-year gilt. It's almost at zero, at 0.217. So what is going on? How come investors are so out of touch with what's going on? Well, I think it's because they've been conditioned to having the central bank put. A put is basically an instrument, an option that allows you to sell something at a certain price. So if the central bank provides a put for a market, it means they'll ensure that that market doesn't go down. And in this case, the gilt prices don't go down. And how do they do that? Well, through money printing, monetizing the debt, QE, buying those gilts, and encouraging investors to buy it, because investors buy it, and then later on the central bank comes and buys it from them, and they even make a profit. They drive down the interest rate. So what are the consequences of this policy? Can they keep it going for longer? Well, the consequences, in my opinion, is that the currency will continue to be debased. And that's one of the reasons why gold has gone up by over 200 pounds this year alone. And I think the UK currency, the pound, is in danger again of collapsing like it did in March when we had the stock market crash. And will the Federal Reserve keep bailing out the UK currency through swaps? Well, that's to be seen. If they don't step up to the plate, I think that warning could become very real. A UK sovereign debt crisis, a default. And we know what happens to interest rates in one of those. We saw during the European sovereign debt crisis, Italian, Spanish, Greek, Irish rates, they went to 7, 10, 12, 15%. So owning gilts, I think, is very dangerous, because what happens when yields spike higher, especially on the longer end, while the prices collapse. So the £100 that you thought you invested with the government is probably going to be worth only like 50 or 40 pounds. So I think it's really important we keep an eye on the pound and on the gilt yields and on the QE. What's the course of action? What would I personally do? Well, the first thing I wouldn't do is to be lending money to the UK government if they think there's a danger of default. That's the last thing I would do. Second thing is if you have paper money savings, because cash is basically a debt instrument, of course, just like a gilt. I would try to have as little as possible, only have enough to cover my monthly expenses. And third, something that I've been advising since I started this channel in late 2015, try to get a hold of precious metals, gold and silver. So there you go. If you enjoyed this video, and I know the message isn't great, but as I say, always it's reality. Yeah, hit the like button if you did enjoy it though. And please share it far and wide. Think about subscribing to the channel if you haven't yet. And you can also follow me on Twitter, Facebook, and all these other platforms below here. I wish you all a great rest of the day. Take care. Bye.